Hello, my name is Matthew Granger and this is the FCTO Weekly Review and Outlook for the week of June 25th, 2012. The Federal Open Market Committee meeting's disappointment was overshadowed by European developments while the dollar rebounded and the yen tumbled. While it was another week full of news flow from Europe, the Federal Open Market Committee meeting could in the end be proved to be the turning point in the market. Disappointment over the Fed's Operation Twist expansion triggered steep sell-off in equities. Dollar rode on the sentiments and rebounded, and the reduced speculation of additional easing could also be reflected in gold's post-FOMC sell-off. Strength in the dollar could also be reflected in the strong close in the dollar index at 82.25, comparing to the intra-week low of 81.18. The Japanese yen was undoubtedly the biggest victim last week. Other major currencies, though, are still holding above near-term support against the dollar. It would probably take one more week before confirming whether the greenback has regained some sustainable strength. The Fed decided to extend Operation Twist through to the year end instead of implementation of the third round of quantitative easing in June. With the amount of $267 billion, the pace of asset purchases and sales would remain unchanged. To our surprise, but indeed a positive sign, the Fed maintained the reference of keeping interest rates at exceptionally low levels at least through to late 2014, rather than delaying the timing of the first rate hike. Economic forecasts were markedly downgraded. The Fed retained the possibility of further easing, but this would depend on the job market situation. Moody's downgraded the credit rating of 15 banks, including banking giants Morgan Stanley and Credit Suisse. Rating of Morgan Stanley was cut 2 notches to Baa1, while that for Credit Suisse was down by 3 notches to A2. Other banks that faced the downgrades included UBS, HSBC and Goldman Sachs. According to the rating agency, all of the banks affected by the actions had significant exposure to the volatility and risk of outsized losses inherent to capital markets activities. Greece's exit worry was alleviated as the pro-bailout parties had finally won enough seats in last week's elections. New Democracy came first, beating the anti-austerity Syriza and forming a coalition government with PASOK and the Democratic Left. Troika is expected to go back to Greece on Monday to reach an agreement on the conditionality of an update of the bailout Memorandum of Understanding. Spain and Italian yields fell back as the market calmed down. The two closely watched debt auctions in Spain went fairly well with decent demand, even though yields soared sharply. According to reports by 2 consulting firms hired by the Spanish government to carry out bank stress tests, it could require 51 to 62 billion euros to recapitalise banks if Spain's GDP shrinks by 6.5% over 3 years and house prices dropped by 60%. That's the worst case scenario. In the central scenario, 16 to 25.6 billion would be needed through to 2014. Spain said that it will formally request for assistance to the banks on Monday, and the terms would be set by July the 9th. Also, it reported that Spain is considering forcing bank shareholders and junior debtors to absorb losses through debt restructuring. There was some support in the bond markets on speculation that the EU could see the European Safety Mechanism bailout fund to buy Italian and Spanish bonds. However, there was no agreement made after a meeting between German Merkel, French Hollande, Italian Monti and Spanish Rajoy. Instead, the leaders just agreed to back a proposed €130 billion plan to boost growth. The International Monetary Fund said in a report that the Eurozone debt crisis is now in a critical stage, and despite extraordinary policy actions, bank and sovereign markets in many parts of the euro area remain under acute stress, raising questions about the viability of the monetary union itself. The IMF also warned that as the financial and economic environment continues to deteriorate, investors are withholding funding from member states most in need, moving capital to safe havens and driving risk premiums to new records. The IMF urged strong commitment from leaders to restore confidence in the euro, and the immediate priority is concrete action towards a banking union for the euro area. That includes harmonised national bank resolution processes and regional deposit guarantee schemes. An induction of a limited form of common debt would provide an intermediate step towards fiscal integration and risk sharing. China pledged to offer an additional $43 billion to the IMF war chest following Russia's pledge of $10 billion. The BRICS leaders, Brazil, Russia, India, China and South Africa, said after a meeting before the G20 summit in Mexico that they agreed to enhance their own contributions to the IMF. They said in a joint statement that these new contributions are being made in anticipation that all the reforms agreed upon in 2010 will be fully implemented in a timely manner, including a comprehensive reform of voting power and reform of quota shares. The June minutes for the Bank of England meeting unveiled that the members were more split on whether to increase asset purchases to stimulate economic growth, with 5 votes favouring no change while 4 votes supporting additional easing. It has become increasingly likely that the central bank would announce a raise in asset purchases at the next meeting. Inflation has moderated more than anticipated and should have created a more comfortable environment for easing policies. The Reserve Bank of Australia minutes for the June meeting suggested that the decision of reducing the policy rate by 25 base points to 3.5% was made after finely balanced arguments among members. Policymakers remained optimistic on the domestic economic outlook, and it was mainly the global economic slowdown, particularly the sovereign debt crisis in the Eurozone, which triggered the rate cut. The central bank viewed the current monetary stance as stimulatory, and thus another rate cut in July appears less likely. Yet if the global economic environment continues to deteriorate, the RBA would still lower interest rates further later in the year. And that's it. For more detailed analysis and daily updates on all the news affecting the Forex market, join us throughout the week at www.forexcurrencytradingonline.co.uk. That's www.forexcurrencytradingonline.co.uk.